The hypothesis would say you can't do that. You can't come up with these kind of trading strategies. In other words, stock prices follow random walks. Autocorrelation should be zero. All right, well, let's take a look. This is the rolling 5-year serial correlation coefficient, first order autocorrelation coefficient for stock returns on a monthly basis for the S&P Composite Index from January of 1871 to April of 2003. That's a lot of data, right? And these are 5-year rolling window correlation. So every five years, I'm going to calculate this correlation coefficient between month T and month T minus 1. And it should be zero. But let's take a look at what happens. In the 1800s, the late 1800s, there was a fair bit of positive correlation. Correlation around 40 or 50%. And then, towards the end of the century, the correlation goes down. Then it goes up. Then it goes way down in the early 1900s. Then it goes up. Then it goes down. Then it goes up. During the 1970s, here, there's a bit of a period where it goes down, then it goes up, then it goes down, then it goes way up. It shoots way up in the 1990s. And then, since the 1990s, it's been relatively low. And actually, if you extended it to the last few years, you'd see that it's still pretty low. This diagram shows that market efficiency, as measured by the first order autocorrelation, first of all, is not zero, but more importantly, it does not decline monotonically over time. Markets are not getting more and more and more efficient. There's a cycle of efficiency. There are periods where the market is very efficient, and there are periods where it's not. And these periods are determined by the population of investors that are interacting with each other. There are periods where markets are extremely efficient because you've got very sophisticated investors in the market. But during the 1990s, that wasn't one of them. Because what was happening during the 1990s? Who was trading here? Anybody know?
Everybody.
Exactly. Retail investors, everybody. You know, the librarian, the pharmacist, mom and pop, grandma, they were all trading on E-Trade, on all of these various different trading sites. And as a result, the market became relatively inefficient. And you can see this. You can see this as clear as day. By the way, right around here was where some of the equity market neutral hedge funds like D.E. Shaw decided to go into business and made a lot of money, in this period. It's gotten a lot harder now.